Welcome back. You're watching Closing Trades on ET now. Well, for what it is worth, we have made a comeback of almost 50 to 60 points from the lowest point of the trading session, but continues to be very, very range bound. I think the good news is that we haven't seen any worsening of momentum after that gap down opening that we saw, and the markets are able to hold on to that 16,400 mark at least for now. Hero MotoCorp has actually put on some more weight. It's now trading with a gain of over 3%, and we have seen some names like Adani Ports also trending higher in the last few minutes. So that also seemed to have moved into the green. And apart from that, we have names like Bajaj Finance, Divi's Labs, UPL, Tata Motor. These are the counters which are trading with quite a bit of red tick. Let's welcome on board Siddharth Vora, Head of Investment Strategy and Fund Manager, PMS at Prabhudas Lilladher. Hi, good afternoon. Thank you so much for joining us, Siddharth. What do you make of the market setup and the market mood that we are in? What are you suggesting your clients at the moment?
So, from a markets perspective, the way we are looking at it right now is that asset allocation is extremely important to navigate this phase of the market cycle. And more than just getting the right stocks or getting the right sector, it's extremely important to have a very tight eye on asset allocation, because I think for the next 1.5 years, that will drive returns and also help manage portfolio risk. The way we look at it from our quantitative perspective is the macro indicators are not very encouraging. The monetary cycle, we are at the cusp of a rate hike cycle. So from an equity perspective, I don't think it's extremely encouraging, and we would be defensive on equity even from our monetary indicators. The valuations, if you look at that, I don't think we are at the bottom of the cycle, and we are fairly highly valued. Momentum in equities compared to other asset classes is also extremely weak. Global risk appetite is also waning, and overall technicals are also suggesting weakness. So from an overall asset allocation perspective, we have been underweight on equities since the last 3 to 4 months, and we continue to be so. That is a view from an asset allocation perspective. We can discuss other sectors and stocks where probably our view is positive.
In regarding the equities that you're talking about and that you've got underweight equities, but since you're talking about portfolio allocation, what according to you would be a good portfolio allocation at the moment? What would your weight be, let's say, for gold, for commodities, for real estate, cash, etc.?
So we're roughly at the 40% mark on equities, 15% on gold, roughly the rest of it between liquid corporate bonds and cash. We are underweight on government securities also. This is obviously, I'm talking about the multi-asset portfolio, not the pure equity, long-only equity offering.
The question is, since you're talking about going underweight on equities, should the investors book the losses that they've already seen in the year? Because a lot of mid-cap stocks have corrected by 30-40%. Are you seeing more downside, or would you suggest for now hold on to your portfolio and maybe not make fresh allocations?
So honestly, booking out losses and profits it's dependent on so many variables, right? What is my time horizon? Why have I bought a particular company? Has anything materially changed in the sector or growth outlook? It obviously depends on multiple variables. But if the portfolio is constructed with a medium-term view or a trading view, obviously caution is demanded. But if the time horizon is very long and enough research has been done in terms of the sustainability of a franchise over the long period of time, then I think one could also ride this cycle.
Interesting. Siddharth, so let's get into some sectors and stocks where you are scouting for opportunities if the market were to decline further, where you would, recommend buying afresh or, adding positions to.
So I'll tell you our views on the key sectors that we are currently holding, and we will continue to buy them based on any corrections that we see. So contrary to probably now how the street has turned negative on IT, I think we will be and we are positive on IT, select IT names of course, where attrition is better managed, our return on capital employed is extremely superior, and there is a proven kind of dominance in some niche segment. So we are bullish on IT, but we'll be managing our allocations in a staggered way. But from a 3 to 5 year structural growth story, I think visibility of growth is extremely important in a scenario like this. And given the dollar tailwind also, I think IT should be one of the important allocations in a portfolio. We are also bullish on select financials, not just banks, but also some financialization of savings play, including some wealth management companies. And in terms of banks, we are absolutely focusing only on high CASA franchises, which are dominant. We're not looking at smaller, mid-sized banks. We're also underweight on NBFCs. And I think banks and the savings-oriented financials is the second play. The third play we are building in the portfolio is to do with resources and energy. This obviously includes soft and hard commodities also. We believe in an inflationary environment, these will provide the kind of resilience needed to the portfolio, and the valuation is also extremely comfortable in most of these names. So I think the portfolio should look at building in the right balance of resilience and growth. And we believe valuation comfort and visible growth will help us do both of those.
Interesting. Siddharth, I'm also wondering whether you're market cap agnostic. Are you looking at specifically large caps, or would you say wherever you find value and growth, buy the names?
Okay, so we run a multi-cap fund, so we are market cap agnostic per se. But when we look at opportunities, we try to find either dominance or some specialized right to win in a particular segment, coupled with growth visibility and valuations. So the opportunities become far and few, but you have to have the conviction to ride those out. So it's not market cap focused. Right now, I think we are more 50%, 55% large cap and the rest between mid and small cap.
I want to probe on, Siddharth, good afternoon, what the allocation is when it comes to the profile of companies that are picked out within the broader universe. Although the allocation may not be as much as the large caps, what's interesting within the broader universe, sectors, stock specific?
So we've recently started turning extremely bullish on Gland Pharma, as we own that name also. And we believe as a specialized play with tremendous pricing power, dollar tailwinds, and very, very high entry barriers in terms of injectables. I think from a structural perspective, we believe that story could really play out well. And the way we are perceiving Gland, I don't think it's as richly valued as it probably deserves to be, given the strong competitive advantage and entry barriers that the franchise possesses. So that's a name we recently added in the portfolio. And other than that, we are also bullish on the entire wealth management space, and we have been owning IIFL Wealth since quite some time, and we might be managing our allocations a little bit in terms of capital market cyclicality, but that's a story, again, we are structurally bullish on, given the financialization of savings, coupled with a strong combination of manufacturing and distribution that IIFL Wealth has. And it is also converting most of its revenue from a transactional base to a recurring revenue base. We think that story has a lot of legs for the near future. Those are just two specific names we spoke about right now.
Interesting names that you flagged up. I wanted to also understand your outlook when it comes to looking at individual sectors, and if in specific I could talk about the cement sector, purely because there has been a lot of news that's taken place with the whole Sim India exit, what that could potentially mean for new players coming in. There's a lot of buzz going about big conglomerates as well looking to lap it up, and anything within mid-cap cement that looks interesting as well as an opportunity to you?
We have not been too bullish on cement since, I would say, the last 6-8 months, and rightfully so, given the cost pressures, margin pressures, and even probably now volumes also coming off a little bit. So we've not been too bullish on cement. We only had a tactical view on Ambuja Cements, I think 3-4 months ago. We've already moved out of that name as well. So not really bullish on cement, and wouldn't want to track it either right now in the inflationary environment. So
taken. But you know what, this global, this risk off that we are seeing is not only an India phenomenon. This is something which is happening across the globe. In fact, if you look at NASDAQ, that has seen some heavy selling. But just to understand which are the stocks and counters which have taken a huge knock when it comes to NASDAQ and how it's related to the Indian IT companies back home, what sort of correction have we already seen? Wanted to get in a take, Siddharth, as to what you're penciling in when it comes to Tata Motors in terms of their overall volume growth, how you're expecting earnings to pan out for them?
Tata Motors is not something we really track from a fund perspective, but from a broader perspective, I know that the CV cycle is doing pretty well, and I think the commercial vehicle volume growth will be positive the way it has been for the last couple of quarters. We also know that Tata Motors is gaining substantial market share in domestic passenger vehicles, but both of these combined are not good enough to move the needle for Tata Motors. So I think the bigger worry or concern would come in from the global business, from the GLR piece. And I think there could be some concerns there given the steep rise in inflation and commodity prices, coupled with supply chain disruptions. So I believe Tata Motors could show some pressure in terms of the overall consolidated numbers this quarter.
Okay, fair enough.